Welcome back, everybody, for another deep dive. This time, we are going to be looking at Islamic banking. Specifically, we're going to be looking at switching costs in Islamic banking. And this isn't just theoretical. We're actually looking at data from 412 banks across 17 countries.
Yes. This research was published in the Journal of Behavioral and Experimental Finance. And what it's doing is it's comparing Islamic and conventional banking systems and how they treat switching costs. And it's really fascinating because it's got implications for how the market operates, but also financial stability as a whole.
Okay, so let's just back up for 1 second. What are switching costs in the context of banking?
Well, imagine you've been with the same bank for a very long time. You've got your checking account, you got your savings account, you might even have a loan or two.
Yeah.
Everything's kind of tied in with this bank. Now imagine another bank comes along and offers better rates or lower fees.
Yeah.
It seems like a no-brainer to switch, right?
Yeah.
Well, not so fast, because then you start thinking about all the hassle of closing your accounts and moving your money, updating all your direct debits and things.
Yeah.
And maybe there's even a fee for leaving your current bank.
Oh, right.
So all those inconveniences and all those potential costs associated with moving your money, those are the switching costs.
That makes sense. I can definitely relate to that. So what did the researchers find out about this?
Well, first of all, they found that Islamic banks consistently have lower switching costs than conventional banks. We're talking about an average difference of about 1%.
Okay.
Now, that might not sound like a lot, but in the world of finance, that's significant.
Interesting. So why would Islamic banks choose to have lower switching costs? I mean, wouldn't it make sense to lock in customers even if it meant higher fees? Get that market power.
Well, this is where the unique principles of Islamic banking come in.
Okay.
One of the core concepts in Islamic banking is something called Maqasid Sharia, which emphasizes social justice and ethical conduct. This means that Islamic banks operate within a set of moral guidelines, which prioritizes fairness and transparency.
Got it.
So this translates into things like avoiding excessive fees and basically making it easier for people to manage their money without feeling trapped.
Okay.
So it's not just about maximizing profits, but it's also about doing what they think is right.
So they're putting their ethics first.
Yeah. And it's not just an idea, it's a reality, because the study provides some very interesting examples. For instance, conventional banks in Yemen, they have an average switching cost of 26.9%.
Whoa.
That is a huge amount for customers who might want to move their money. And then on the other hand, in Tunisia, both conventional and Islamic banks have much lower switching costs. It hovers around 3.5% to 4.5%.
Okay.
So this gap can vary from country to country. But overall, Islamic banks do seem to make it easier for customers to switch.
Well, I mean, 26.9% is a lot to pay if you want to switch banks. But I have a question. Islamic banking is a fairly new industry, right? So how can they be so competitive on price, especially when it comes to switching costs? I mean, wouldn't you expect them to focus on gaining new customers, even if it meant having higher fees initially?
It's a good question. And what this suggests is that Islamic banks might be playing the long game. They might be more focused on building trust and loyalty from the get-go, rather than just trying to make a quick buck.
Right.
And they might be more willing to absorb the costs of lower switching fees in order to cultivate those long-term relationships with customers who appreciate this more ethical approach.
Okay, that makes sense. So we've established that Islamic banks have lower switching costs, possibly because of their commitment to Maqasid Sharia. But how does this all relate to market competition and financial stability?
Well, to understand that, we need to talk about the harvesting effect.
Ooh, the harvesting effect.
Okay, it's not as scary as it sounds.
Okay, good.
But basically what it is it's what happens when switching costs are high. If it's really expensive for you to leave your bank, even if you're not happy with their service, you're more likely to just stay put.
Right.
And this gives banks a lot of leverage because they can kind of get away with charging higher fees or offering less competitive products because they know their customers are essentially stuck.
So it's kind of like a captive audience almost.
Exactly. And the research actually confirms this. They use something called the learner index, which is basically a way to measure market power. And they found a direct link between higher switching costs and a higher learner index.
So the harder it is to switch banks, the less competition there is, and the more power the banks have.
Exactly.
Okay. But I'm a little confused because I thought Islamic banks had lower switching costs. So wouldn't they have less market power?
Well, this is where things get really interesting. While it's true that Islamic banks generally have lower switching costs, the research found that the impact of those costs on market power is actually stronger for Islamic banks.
Wait, hold on. That seems counterintuitive. Can you explain what's going on there?
Sure, it's a little counterintuitive at first, but there are a couple of factors here. First, remember that Islamic banking is a relatively young industry.
Right.
They're still growing, trying to attract new customers
Mm-hmm.
and establish themselves in the market.
Right.
So even a small increase in customer retention, which they get because of the lower switching costs, can have a big impact on their market share.
So it's like they're using those low switching costs to build a loyal customer base early on.
That's exactly right. Think of it like a hot new startup. They might offer amazing deals to get you on board, and they might not always be the cheapest in the long run. But that initial loyalty that you build up, it can be really, really powerful.
Okay, that makes sense. So Islamic banks are kind of like the cool new kid on the block.
Yeah.
Shaking things up a bit.
Yeah, I think that's a good way to put it. And it'll be really interesting to see how this dynamic plays out over the long term, especially considering that Islamic finance is projected to be like a $3.69 trillion industry by 2024.
Whoa, that is huge. And I can definitely see how that kind of growth could really disrupt the traditional banking landscape, especially if they continue to offer these low switching costs.
Yeah, just imagine. Imagine a world where you've got the choice between conventional banking with its potentially high fees and Islamic banking, which emphasizes ethical practice, has lower switching costs.
Yeah.
It could really force traditional banks to rethink their strategies.
It's like they'd have to up their game or risk losing customers.
Exactly. Competition breeds innovation. And it's not just about price either. We'd see better customer service, more innovation, across the board.
Yeah, look at what fintech has done to the banking industry. These new sleek apps, user-friendly interfaces, and all the traditional banks are having to scramble to catch up.
Exactly. And this pressure from Islamic banking, it could have a very similar effect and ultimately benefit customers, no matter where they bank.
Yeah, so this is good news for consumers, right? More choice, better service, potentially lower fees.
Absolutely.
Yeah.
But there's another layer to this story that we need to unpack, and that's the relationship between switching costs and financial stability.
Okay, now this is where I start to get nervous, because we've been talking about the benefits of lower switching costs, but are there any downsides? Could too much competition actually be bad for the banking system, make it unstable?
That's a really important question. And it's something that the researchers actually looked into. They used something called the Z-score to assess the financial health of banks in the study.
Hold on, another term. What's the Z-score?
Right. The Z-score is basically a measure of a bank's resilience.
Okay.
Its ability to withstand financial shocks and things. So the higher the Z-score, the further away a bank is from potential insolvency.
Okay, so a high score is a good thing.
Yeah. High score means the bank is less likely to collapse.
Got it.
And what's really interesting is the researchers found a really surprising correlation. Higher switching costs actually seem to decrease financial stability.
Really?
For both types of banks.
Well, that's counterintuitive. If banks have all this market power because of high switching costs, shouldn't that make them more stable? Not less.
You would think so, wouldn't you? But this finding actually supports this idea that too much customer lock-in can actually be a bad thing for stability in the long run. It's all about finding the balance.
Okay, my brain is trying to catch up. How can having these high switching costs, which, give the banks all this power, how could that make them less stable?
Well, think about it like this. If a bank knows that their customers can't really go anywhere, they might get a bit lazy, complacent.
Yeah.
They might not feel as much pressure to innovate or offer good products because they know that they've got those customers locked in.
So they get a little comfortable.
Exactly. And that can make them very vulnerable because if a new player comes along with a really disruptive business model, or if the economy suddenly changes, these banks with these high switching costs, they might find themselves struggling to adapt.
It's like they've built their house on sand, instead of solid ground.
It's a good analogy. And this links back to the Stenbaka and Takalo theory, which is basically that too much focus on your existing customers can stifle innovation and competition in the long run. It's all about finding that sweet spot between attracting new customers, but also making sure your existing customers are happy, but without resorting to these, lock-in tactics.
Right, so it's not as simple as saying, lower switching costs are always good.
No, there's nuance. There's a balance to be struck. And this is something that banks and regulators need to really think about.
So what should the role of regulators be? I mean, should they be trying to step in to encourage more competition around switching costs, or should they just let the market figure it out on its own?
Yeah, those are the million-dollar questions.
Yeah.
And I don't think there's an easy answer.
Yeah.
But I think there are valid arguments on both sides. And that's what makes this topic so fascinating. It really gets you thinking about how you want the financial system to work.
I'm hooked. This has been a real roller coaster of insights. And I can't wait to see what we uncover next.
Me too. In the next part, we're going to look at this question of regulatory intervention. Should governments step in and try to encourage more competition around these switching costs, or are there better approaches?
Sounds juicy. Don't go anywhere, listeners. We'll be right back with part 2 of our deep dive into switching costs and banking. Okay, so where were we?
We were talking about the potential downsides of high switching costs.
Right. And the fact that maybe, surprisingly, they might actually make banks less stable in the long run.
Exactly, because they can lead to complacency. Banks might not feel the same pressure to innovate or offer competitive products if they know their customers are stuck.
So it's like a double-edged sword. High switching costs might give banks more market power in the short term, but in the long run, it could backfire.
Yeah, that's a good way to put it. And it makes you wonder, what's the right balance?
Yeah, what should regulators be doing? I mean, should they try to push switching costs lower? Or is it better to let the market sort itself out?
Well, there are a few different schools of thought on that. Some people argue that regulators should absolutely step in. Maybe impose caps on switching fees or make it easier for customers to transfer their accounts.
Like make it a smoother process.
Exactly. They argue that this would increase competition, force banks to be more innovative, and ultimately benefit consumers.
That makes sense. But what about the other side of the argument? What do the people who say hands off think?
Well, they worry that too much intervention could actually harm the banking system. They argue that if you make it too easy for customers to switch, you could create instability.
How so?
Well, imagine a scenario where customers are constantly jumping from bank to bank, chasing the absolute lowest fees.
Oh, like playing musical chairs with their money?
Exactly. And they might not be considering other important factors, like the quality of service or the long-term stability of the bank.
Right. It's like you don't want people making decisions solely based on, who's offering a $5 bonus for opening an account.
Exactly. And there's another concern. If you force banks to constantly lower their switching costs, it could squeeze their profits.
Right, which could hurt their ability to invest in new technology, improve security, all that stuff.
Exactly. So it's a complex issue. There are valid arguments on both sides.
So what's the answer? What's the magic formula?
Honestly, I don't think there is a one-size-fits-all solution. It's going to vary depending on the specific market conditions, the regulatory environment, lots of factors.
Okay, so maybe instead of focusing on a specific number or a hard rule about switching costs, we should be thinking about the bigger picture.
I think that's a good way to look at it. Instead of trying to micromanage every fee, maybe regulators should focus on creating a more competitive environment overall.
How would you do that?
Well, one idea is to encourage banks to compete on more than just price. Things like customer service, product innovation, ethical practices.
So it's not just about being the cheapest, it's about being the best, in a broader sense.
Exactly. And that gives consumers more choice. They can decide which factors are most important to them.
So maybe the key is to empower consumers to make informed decisions. Give them the tools and the information they need to choose the bank that best aligns with their values.
That's a great point, because ultimately a healthy banking system is one that serves the needs of both consumers and the economy as a whole.
This is making my head spin, but in a good way.
Yeah.
It's amazing how something as seemingly simple as switching costs can open up this whole conversation about competition, ethics, stability, all these big ideas.
It really shows how interconnected everything is in the world of finance.
Well, I think we've done a pretty good job of unpacking this issue.
I think so too.
But before we wrap up, I want to leave our listeners with one final question to ponder. If Islamic banking, with its emphasis on ethical principles like Maqasid Sharia, is kind of setting a new standard for customer-centric practices, how might that influence the future of finance as a whole?
That's a great question. And I think it's one that we're going to be exploring for years to come.
Thanks for joining us on this deep dive, everyone. Remember, keep learning, keep questioning, and keep diving deep.
Okay, so should regulators step in and try to really shake things up when it comes to switching costs?
Well, it's tough to say. On the one hand, we've seen that lower switching costs, they can be good for customers, right?
Right.
More competition, potentially better products.
Yeah. And they could make the banking system more stable overall.
Right, because banks can't just get complacent. They have to keep innovating.
Exactly. But on the other hand, is there a risk of pushing this too far?
Yeah, I mean, some people worry that if you focus too much on switching costs, you could end up with this, like, rate-chasing frenzy.
Rate chasing. What's that?
Well, it's like, imagine customers are just constantly hopping from one bank to the next, just chasing the absolute lowest fee,
Oh, I see.
without really thinking about other things, like the quality of service or how stable the bank is.
It's like people who are always signing up for new credit cards just to get the introductory offer. Exactly. And there's another potential downside. If you force banks to constantly keep lowering their switching costs, it could really squeeze their profits.
Right, that makes sense.
And they might not have enough money to invest in new technology or improve their security or even, like, expand their branch network.
So it's like a balancing act again.
Yeah, exactly. We want banking services that are affordable for everyone, but we also need banks to be healthy
Right.
and able to invest in the future. So finding that sweet spot is really important.
So what's the answer then? What should regulators do?
Well, I think instead of just trying to force switching costs down, maybe they should be thinking about how to create a more competitive landscape overall.
Okay, how do you do that?
Well, you encourage banks to compete on things other than just price.
Yeah. Like what?
Like customer service, innovative products, ethical practices even.
Right, so it's not just about being the cheapest, it's about being the best, like the best overall bank.
Exactly. And that gives customers more choice, right? They can decide what's important to them and choose the bank that fits their needs.
So it's about giving consumers the information they need to make good choices.
Exactly. Because at the end of the day, a good banking system is one that works for everyone. Customers, the economy, everyone.
This deep dive has been amazing. Who knew that switching costs were so complicated?
Right.
It's really made me think about how everything's connected in finance.
Definitely.
Well, I think we've covered a lot of ground today, but I want to leave our listeners with one last thought. We talked about Islamic banking and how it emphasizes ethical principles. If that becomes the new standard, how will that change the future of finance?
It's a good question. And I think it's something we're all going to have to watch closely.
Absolutely. Well, thanks for joining us for this deep dive. And remember, keep learning, keep questioning, and keep diving deep.